Hi, so good afternoon. I think the earlier session has taken away all the inertia that lunch usually brings in, and we're all here, active and interested in what's going on. So good afternoon, everybody. We have a good panel here. I think I was very excited to see the names of people who we have here because each of us belong to a different part of this overall private equity ecosystem. I do private equity and I do a lot of angel investments, which are really early stage. And we have people who do private equity, minority stakes, significant minority, controlling stakes, and then we have, VC among us. So I think what we'll do is we'll just first go around the panel, starting, each of us will just share, what we do, etc. And then we start off with what is conventional, what is non-conventional in the private equity world. Sandeep, yeah.
Hi. I'm Sandeep. I'm with a firm called Peepul Capital based in Chennai. We've been doing growth capital for about 15 or 16 years. Started off very much oriented towards what one would call venture, early stage technology investments. We've largely been playing into the consumption story that's been playing out in this market. Typically, we try and put somewhere between $20 to $40 million of equity capital to work. We're almost always a control investor. In fact, over the last pool of capital, we probably have somewhere around 2/3 or more of our capital where we own these businesses outright. So that's kind of what we do.
Excellent. Sanjay, your part of the world?
Thanks, Rajesh. Sanjay with Blume Ventures. Karthik and I started Blume in about 2010, and the first fund was about 15 million. The entire fund, which is smaller than either Dhiraj and Sandeep cut single checks. We just closed our second fund with about 60 million, and it's been very interesting to be part of this for the last couple of years because I think our space is defined by the page 6, right? On Economic Times, we've seen your beneficiaries of the rise, but then also the ups and downs, and I think that's been a very interesting space. We look at B2C. We are shareholders in Ola. We also look at B2B. We've got a couple of interesting SaaS and other IP-led robotics companies, and also focus on SMB. And I think it's and of course we both got our start, and we're both members of the Mumbai Angels, which is another very interesting place to look at these early stage companies and see the progression. I think what's really interesting is the companies that make it out and progress and go to the larger check writers is interesting to trace their the history. So I think it's an exciting time, but obviously 2017 we need to get more out of the portfolio, look at more exits and acquisitions.
Excellent. So focus on exits. Dhiraj.
I'm Dhiraj. I represent TA Associates. We're a late stage growth equity fund. What Sanjay didn't say is he looks for 25x, 50x, 100x. We basically shoot for a 25% IRR. US headquartered fund. We've been in the business for about 5 decades. Been in India now for about 7 years. We typically invest in a few sectors. It's consumer, healthcare, financial services. We do a fair bit of tech as well, enterprise software and things like that. We are late stage investors in the sense that the companies need to be profitable before we can come in. Often we invest either by giving exit to earliest round investors, early stage investors, liquidity to founders, which in the Indian context, I guess could be called somewhat unconventional. But we stick to our sectors, and the kind of businesses we do are generally growing at a nice pace, 25-30%, steady growth, good operating cash flows. So that would describe it. In some of the examples of where we made investments include Dr. Lal's Path Labs or BillDesk, a payments business. So that's about us.
Excellent, thank you. So I'm Rajesh, work with Franklin Templeton Investments on the emerging market side. I've been there since '99. And the style of investment, as Templeton is very well known for, is value investments. So we do largely public equities, and so that's been a large part of my experience doing managing funds across emerging markets. We also have a private equity fund, which we started in the year 2000. We've done 4 of those. We're now raising capital for the 5th one, which is not a fact that we publicize too much, because again, this is not India dedicated money. These are all emerging market funds. And as Sanjay briefly said, that I am also part of Mumbai Angels on a personal level. I do a lot of startups and early stage deals. And I find that part of the ecosystem the most exciting among all the other parts that we discussed. So that's briefly about us. I think we'll quickly jump into, let's start with you first. So the topic that we're discussing today, Sandeep, is something about non-conventional aspects of private equity investing. And we all on this stage have some experience in the private equity ecosystem. What is conventional in your part of the world? So, for example, if I'm an investment banker and I come to you with a deal, what would be a conventional deal that I should get to you?
Conventional to me or generally in the market?
To you. What will work with you?
Well, for us, obviously, control is something that is vital for us.
Excellent.
Control and, of course, the first starting point is the type of business.
Right.
So clearly, we're biased towards certain sectors. Transparency of the business model is key.
Yes.
Ability to generate the kind of returns that we're paid to deliver is another important aspect. But
so 20-30% ROE businesses are fine with you, or you need?
Yeah, thereabouts or a little higher.
That's the
yeah. I mean, we look at it more from an IRR rather than ROE because there's various things. But from an IRR point of view, probably a little higher than that.
All right.
Really is what the capital that we source is looking for.
Right.
And thereafter, in terms of that's probably what most investors would be seeking. But thereafter, we typically seek control. Very often, we buy out entirely. And the other aspect would be a certain kind of economy of scale in terms of capital being put to work.
Right.
So those would be the
so very interesting, So when we invest across emerging markets at Templeton and we talk of different markets with our LPs, one of the things that they always mention about India is that this is a market where you just can't do controlled deals. I think now we have an example that we all should talk about more, because I think for the Indian private equity ecosystem, having global LPs understand that controlled deals can be done here, buyouts can be done here is extremely important. Otherwise, it's we can keep talking about India shining, etc. Capital is difficult to come by. So excellent, very good. Just one thing to round up. So what's your investment horizon? You are invested in companies for how long?
So historically, it's been, we try and underwrite investments around 5-ish years plus or minus.
Okay.
But I think given where learnings have been, we've kind of been at this for some time.
Right.
And there's been some insights into what it takes to get to critical mass, to get to that kind of resilience and significance or relevance rather.
Right.
I would imagine that our horizons are going to get a little longer. Going forward.
Right. So one last question before we move to Sanjay. So what's whom would you exit to? Who would buy you out?
Typically, we have strategics, larger global.
But they have control.
Sponsors.
You don't take control.
We're happy to partner, right? So, I mean, we have enough examples where financial investors have sold to us. They may even continue running the business.
Okay.
We don't do, when we just, sorry, and I'm probably cutting it into your space here, but we would take majority positions. What we don't
so
do
you
is
would
we
take
won't
majority.
control. So we have companies where we own 90%, but the founder or CEO continues to run the business as if it's his own. We will be active at the board. We'll be active as a shareholder. We don't need to necessarily go in and change things around. So we will pick a well-running business and provide liquidity in that sort of a situation.
Well, absolutely. In fact, the bulk of our demand comes from these sorts of firms.
Okay.
Because, that's what they've been doing in their traditional markets.
True.
And our ability to deliver a $100, $200, $300 million deal with with typical global private equity type controls becomes very attractive. So that's really the model.
Excellent. Sanjay, up to you.
I can try and be the banker between them when they do it. It's interesting, Rajesh, the question you're asking, because, as really early stage investors, we have to be the most unconventional in one sense, right? So
but that's conventional for you, right?
Right. So what's conventional is, I'd say, if you look at our fund one, right, look at pure play, let's say e-commerce companies which are really going after grabbing a large share of the market. We won Taxi for Sure, which started at the same time as Ola Cabs, and then Ola Cabs grew faster, raised much more capital, and then it got acquired. That's quite conventional, right? Because large market size, Indian demographics. So consumer internet has been quite conventional. Even enterprise, on the enterprise side, it's been in, known and tested areas like, let's say, software as a service, or let's say, a mix of outsourcing and platforms.
Yeah.
We'll get to the unconventional side later, but I'd say, typically teams with startup experience or with some pedigrees coming to us with, with more than a plan, with either, let's say, 10,000 downloads if you're a mobile gaming company, or users already, that's quite conventional.
So you need traction. You need to see something going on in the real world, not just a business plan.
And what I'd say is, I think, the ecosystem is still very, very young. I mean, we've just closed our second fund, but if you look at, again, going back to page 6, and you look at the number of deals that get announced, it's like an inverted funnel, and there's a very high failure rate, right? If you actually look at the number of Series A VCs, I see Mr. TCM here from IDG Ventures, that Series A bucket has not really changed in the longest time, right? There's still only about 12, 13 check writers. So you've got a huge funnel in terms of angel groups, individual angels, family office getting to the space. But the companies that make it to A and B is still very small.
Very few.
So it's still very young here.
Right. So a typical deal for you will be either B2C or B2B, doesn't matter, but has to have some kind of traction, and the average check size will be how much?
So, if you look at mobile angels also, when we started about, let's say 5 years ago, I think there a typical entry check size was, typically 1 or 2 crores for, let's say, 10 crore valuation pre-money.
Right.
I think founders, the quality of founders is better today. So they're raising more capital. That has become at least $500,000 to $1 million at about 2x the valuation. I think what is interesting is 2016 was, and the last 2 years was a period of over exuberance, and valuations and expectations have ratcheted and become more realistic, which is good overall, much healthier overall.
So when I do the angel investments, I can look at you for exits, right? Say yes.
Yeah, we'll see.
Just
Yeah,
kidding.
sure.
So do you give exits to angel investors when you get in, or you're happy working with them?
I think so this is interesting, right? And we've written blog posts on this. There are different kinds of angels. I think if you look at we really like to think if you look at value-added angels, they're adding value more than just the check, right? So they either understand the domain expertise, or they're entrepreneurs,
Yes.
or advisors. But sometimes it's just very messy, right? You may actually see a cap table with about 20 angel investors, and it just makes sense to clean it up, and they've got a fair bump up,
Yes.
and it's win-win, and then you do it. Sometimes you actually want them to stay on. Like, I'll give you an example of Rajan Anandan, for example, the head of Google, who's a super angel. Is fantastic in board meetings, has great data to share, really has value, has very positive energy. Like I think on Capillary, for example, which is not a portfolio company of ours, he's still on the board, or rather got elected to the board, but his check size is very small. So it really depends.
Tremendous value add that is bringing in addition to the check.
Because I think the earlier stage you are, the more help you need.
Yeah,
right?
absolutely.
And then once you get mature, you're hiring those senior managers and leaders whose task is to steady the ship and meet targets. Right? When you're early, you're figuring it out, and any help that can help you save time and get to the next level ASAP, it really helps.
Right. So we understand you. Dhiraj, what's conventional for you?
Actually, I'm not sure I know the answer. I mean, we've been around for a long time, but the firm keeps changing its own rules and bending its own rules along the way to try and find ways to make money. So I think
I see a lot of mutual fund guys here always saying this is style drift. You can't do that.
Yeah. So we've managed to convince our LPs that we don't drift our style. But I think we have a certain set of rules that are part of our mandate, which we don't bend or we don't break, which includes, we do only profitable businesses. And we have a fairly stringent understanding of what profitability really means, not gross margin 1, gross margin 2, or any of that. I mean, the business needs to generate cash profits. It needs to be self-sustaining in terms of being able to fund its growth. The second part is actually growth itself. So it's profitable and growth. We would not do a turnaround. We don't understand how to do a turnaround. And in the context of us not taking control, it's an important parameter where you say, the management knows what it's doing. It did not get into trouble. The business was performing well, and we stick with that. So barring these two, I think when it comes to every other rule, I think we've done unconventional deals. We said we won't do capital-intensive sectors, but we've gone and done pharma. We've done core manufacturing. We've said, we want to see, we've taken pre-IPO type positions. We've participated in an IPO. But I think what we've tried to do is we've tried to stay very, very focused on businesses or sectors that we understand really, really well, where we have a point of view well before a transaction comes about. And then we say, look, there are no other rules. If it's if it's a single-digit stake, so be it. If it's a 90% stake, so be it. If it's a listed company, that's fine. If we are the largest investor on the cap table, that's great. If we are not, it's okay. We'll play second fiddle to anybody. It doesn't matter. If it's a pure liquidity transaction where the founder is selling 75% of his business today, we'll even take those positions. So we keep a lot of flexibility around it, because at some level we also have an understanding that we're out of business if we narrow down the field too much, and we want to have enough of a funnel. Now, it's interesting, our style is the same across markets. So what we do works in the US, works across Europe, has so far, touch wood, seems like it's working in Asia as well. So I think we call ourselves reasonably flexible within the boundaries that we've established. And these are very hard boundaries.
Right. And so the investment horizon is going to be typically for you?
It's fairly long. So our fund is a 10+3. Our average holding period is about 7 years. One of the reasons why we do that is we recognize that we're not in control of our exit at all points of time. We will do what works for the business, what works for the management, what works for the founder, and we will not force our way around doing these things, which means we need to have the flexibility in our own fund structure to be able to accommodate a lot of this.
True, excellent. So just briefly on what we do at Templeton in terms of our approach to investing, as I think it's well publicized, value investments, bottom-up philosophy, so we focus more on the businesses. We can be least concerned about which sector that belongs to. We have capital that invests across emerging markets, so we are also not country focused. We never start the year by saying, let's allocate 20% to India, 40% to China, 10 goes to Brazil, something goes to Russia. It's not how it works. It's all at that point in time in the cycle, global cycle, where we find opportunities. So there have been, in our first private equity fund, we had a very high weightage, that was early 2000s. Very high weightage to Russia and Central Eastern Europe, did fantastically well for us. Second and third fund, it's largely been Asia. Fourth fund has been all across, and the fifth one we are about to raise now, and we have some ideas on where that capital is going to be. So it's very opportunistic in that perspective. Investment time horizon is typically 6 to 8 years is what we look at. It's very interesting because on the public side, where we have open-ended funds and we invest like any other foreign investor, there are some companies that we've held for more than 20 plus years. So that's the mindset and the approach that we bring to our investment portfolios. So that said, let's shift the order. What do you think is non-conventional for you? Because right now, if I was an investment banker sitting there, I heard that, okay, profitable company, doesn't matter who's selling, what they're doing, which industry, which sector, let's go to this guy and show him the deal at least. Yeah, so what's non-conventional?
We would encourage that, frankly, because we don't know where our next deal is coming from. I mean, we just invested in a listed company called Shilpa Medicare. It's not what I would have described as our sort of focus area. I mean, we met the entrepreneur, we liked what they were doing, we heard out the story, it's a listed company, you can only do that much work. Right. We don't rely on an external consulting firm to write up a report on the basis of which we do the investment. We go meet everybody we can in the ecosystem, form our view, sometimes we get it wrong. We reach the conclusion that there was something to be done here, and we pull the trigger on it, right? So in our own mindset, that's unconventional. And that's, pipe investing, which in the Indian context would be described as pretty conventional, right, for private equity.
Hey, we do pipes. We do a lot of pipes. Yeah. So I sit on listed company boards. Do you take board positions on listed companies?
So, yes, we do. And we are okay if a board seat is not available, provided we are happy with what we're investing into as well. Right? So again, there's some flexibility around it. And I know enough funds will say, look, we will not take a position in a listed company unless we have a certain amount of influence, and you define influence through a board seat, right? Now, here we have a board seat, and it's not a very large stake because I guess at some level the founder felt that we could be helpful to him. Right. And he sort of elected us in, but we didn't ask for it, we didn't negotiate for it.
It's not part of your SPA then?
No, it's not.
Excellent. As policy, I never do investments where I don't get a board seat. And it didn't start like that. I have had bad experiences, I must share with you. But,
we'll find out.
just saying. Sanjay, what's non-conventional for you?
Sure.
We heard what's conventional. So what is it that you would not be known to do?
Sure. So if you look at the Valley, for example, right, where we get a lot of our sort of global benchmarking and learnings and insights, we spend a lot of time there. You've got Elon Musk who's sending space shuttles and sending people to the moon. Yeah. and I think we're doing all this interesting stuff in India. But one of the reasons you conventionally can't do that is, like we talked about, the next check writer syndrome, right? That who is going to back this company after you? Now, if you are an entrepreneur like Elon Musk and you have that capital yourself, that's great because you can back yourself. I think here the market is much more shallow. So as a result, what we've seen is some of our really interesting companies, we've made some unconventional bets, but we've got to work much harder because they're not understood. And I think generally investors, we don't understand the space. And I totally respect that. They'll say we only invest in spaces. We understand who do you go to. And recently, I think, I'll come back with some examples, but recently I think we've been developing the ecosystem to include lots of strategics from Japan, from China, from the Far East, lots of corporates from the US, from the Valley who are coming in and setting up these innovation programs to look at these companies. So I'll give you some examples of what is unconventional. We've actually just backed a company in Bangalore called Tricog, and what they do is they make a ECG monitoring device that sits atop like a GE Healthcare ECG. And traditionally, it takes almost about half an hour to get an ECG result. If you actually go to your, let's say, your cardiologist, and it has to go and get analyzed. And what they've come up with a cloud solution, and in 2 minutes, with a team of data scientists and cardiologists, they get out the result. That could be life-saving, right? And that's very interesting. That is
so this is independent of the
So
right?
This actually is think of a set-top box, right? This is a set-top box that sits atop a ECG machine. GE Healthcare has come in. The John Flannery, who's the head from the US, came down. They've set up a partnership with them. They actually have an accelerator. They've accepted them into the program, the first startup. Very unconventional in one sense. There is a business model, it's revenue sharing, but it can be transformative, right? That's one example.
So if it's not confidential, can you share with us at what stage did you get into this company?
So typically, just like you look at the Mumbai Angels, most companies, startups that start, we were talking about the pre-panel, we like skin in the game, right? We like it when the entrepreneurs have put in some money, not taken salaries, because that shows that, you're going to win on the upside, but you'll also lose on the downside. That's important. Right. You can't just walk away. Right. Typically, they have raised at least 50 lakhs to 75 lakhs, about less than a crore, and then we come in with at least about, let's say, 500,000. Right. And then another VC has also come in along with us. Other company, robotics, right? Greyonish Robotics, which has been been talked about because it's a Fund 1 company. They developed India's first humanoid robot. Now, frankly speaking, and I'll share. They're juniors of mine from BITS Pilani, and I just happened to be on the steering committee. It wasn't like I was brilliant. We just happened to see it, and we took a punt. At that time, they were actually assembling robotics kits for students, right, for schools. And today they're actually making robots that automate warehouses. Very scalable, very transformative, because they're not replacing workers, they're just making them more efficient. Typically, I think a worker you've got to walk miles and aisles in those warehouses, and then there's lots of fatigue, right? And this is just making that more efficient. Very scalable, very profitable, and growing fast, so unconventional. So I think that the challenge for us, the bar is higher. I see TCM, I see Sanjay Mehta as your fellow angel investor. I think our challenge is who are you going to take this company to, right, in those non-conventional areas? Yes. Because otherwise you're just stuck with a very interesting company.
That's why you mentioned the funnel that becomes.
And eventually, you have to deliver returns to LPs in a certain amount of time, and you've got to reduce those risk variables. But we are very bullish about it because I think founders are coming out with actual startup experience. B2B has become a very interesting segment, and I think the proportion of unconventional or non-conventional to conventional, we think will increase now.
In your portfolio?
Yeah, in our portfolio and I think industry in general.
Oh, that's interesting. Let's hear from you, sir, with some examples, if possible, of non-conventional approach or investments that you made.
I guess when you asked your earlier question about what is conventional, I guess that has been 15 or 16 years of trial and error.
Right.
And that will continue. So in a sense, our approach is somewhat unconventional anyway.
Right.
To what is prevailing in this market.
Right.
So, there's nothing in terms of, unconventional. Fundamentally, it's very simple, right? We are aiming for certain transparent returns of a level and an ability to control our destiny. Anything that facilitates that is open season. So we've done startups where we've started businesses from scratch, we've done buyouts, we've done growth. So all of this has happened, right? We've done early stage tech where he sits today, that's where we were. 15, 16 years ago. We've obviously evolved from there. So it's been a journey. So
Right.
it's not that we started off with what I described a few minutes ago
Right.
as this is where we are and then we're going to do something else. So there's been learning, there's been tweaking, and I'm sure there'll be more lessons learned
Absolutely.
as we go. But as Dhiraj was also saying, ultimately we're economic animals and we're chasing returns and outcomes.
Right.
Whatever facilitates that. I mean, today I haven't been confronted with something that says, wow, this is unconventional.
Right.
Right? I think fundamentally we come in as owners. So if that is unconventional, maybe.
Right.
We are owners of businesses, we're not investors of businesses.
But that's the way you think anyway, right? You think of
Absolutely.
owning the business.
Yeah.
So that's very, very.
But right now we are far more emphatic about it.
Right.
We were a lot more subtle about it for 10, 15 years.
Right.
Thinking that's the way we should be.
Right.
Realize that doesn't work.
Yeah. You might as well go have control and
We're very open
make
about
things
it.
happen.
Yeah. Yeah, absolutely.
Right.
So I'm sorry if I've been unable to give you specific
No,
examples.
that's great.
But
So the flip to that is, will you ever do what he does? Will you ever co-invest with him or with us?
we will I mean, obviously we co-invest with firms we know very well.
Right.
I mean, as we get to know them,
Yes.
for sure.
Okay.
But we may not co-invest with him in an opportunity to go on 6% of
Right.
a public company.
Right.
Right? That's really not what we do.
Doesn't make sense.
See, and part of it is coming from the fact that we have a very large, or relatively large, proprietary component to our capital.
Right. Yes.
So we are not all third-party capital.
That gives you the muscle, I think, because
Well,
you
not
are
just muscle, but it's a mindset.
Yeah.
So 15 to 18 cents on the dollar,
Right.
or 15 to 18 paisa on the rupee,
Right.
is our own.
Yeah.
So we're not money managers.
Right.
We are
That's
entrepreneurs who happen to be layering on third-party capital.
Correct.
Right?
Helping that
as,
capital
as
get
owners of
invested.
businesses.
Right. Interesting.
So that's really what we are.
Interesting. So I can just think about our LPs and general LP population globally, and if you go to them and you tell them this is what I do, there'll be a lot of explanation to be given, I think. What do you think?
No, I think what Sandeep's describing may be unconventional in the Indian context, but it's a tried and tested formula, and there are firms who built serious deep capability to try and succeed in that. I think, look, it's like everything else. The market has a lot of segments. You develop your capability to address a certain segment. What works for you, you get better at it, and you keep building core competence at it. I think that's what it is. And you guys have chosen a hard path in the Indian context, and there are reasons for it, right? And I think we're discussing this offline, right? But there are reasons why you want to take control in those situations and build out businesses, because the returns are higher, the risk is lower, you have ability to control your destiny. Our stock selection in that sense is very, very careful, because we know that there's an automatic adverse selection risk in what we do. Right? And we've developed the capability, and we get it wrong. Our loss ratio is probably higher than many other funds of our size. But then when we get returns, we make good returns. So in some sense, we are a venture fund which has transformed into a growth fund. We're not a leveraged buyout firm, despite being a large American firm. And that particular market segment has worked for us.
Yes.
Right? And in that sense, we are unconventional in our own way.
Right.
So,
And I think not many people will know, but they started off as a VC firm. Very, very small, early stage investments. Right? Nowadays, I think TA is not associated with that, or TA Associates is not associated with that genre, but really. So that's somewhere in their
it's part of the DNA of
Yeah,
the
somewhere in the DNA, and that shows. So you mentioned loss ratio. Can you elaborate a little bit more? I mean, what's the capacity that your portfolio, when you're constructing your portfolio over the life cycle of the fund, do you build in that? Okay, this is going to be a loss ratio we can tolerate.
No, we don't. I mean, look, ultimately being an old firm, we have certain terms, and we try and optimize within that terms and what returns we want to at least generate, right? So we don't construct a portfolio thinking that this is my high risk portfolio, this is my steady part core of the portfolio, but once you've invested, you very quickly find out a certain set of those investments have become high risk, much more than what you thought, right?
Right.
And you decide how you want to focus your energy. So we will try and ensure we bring back capital no matter what.
Right.
And I think that's an important part of it. So we try and minimize the loss ratio. But the number of investments which don't perform could be higher than a traditional late stage fund.
Right.
And when we get it right, we don't end up making 25% IRR. We also make 10x's, which is also reasonably unusual in a fund which does not do leverage buyouts and is not playing on the margin of cycles and so on, right? So
Very interesting.
We're taking slightly higher risk, and we know that some things will go wrong. I mean, to that extent, we also don't model out our investments the next 5 years to the last percentage point on every line item. We just don't do that. We know what risks we're taking. We spend a lot of time thinking through the thesis. We hate to be surprised on a risk we did not see in the business going in. If it then hits us, we say, okay, it's a risk we took knowingly. That's how we think about it.
Right. Excellent. So, I mean, just a little difference from what we do at Templeton is we would, when we are making our investments, so as I said, we don't start off by saying these are the countries where we should be deploying capital, these are the industries that we need to be associated with. We are really bottom-up, general fund. But the loss ratio that we discussed for us, we will not, the fund structure is such, and we do late stage, right, or we do pipes. So the capacity to take losses on our investments is very, 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 very low. And that, therefore, when going into the investment, we need to be more certain than what I would do for my startups or than what Sanjay would do for his ecosystem. But then coming back to Sanjay, so what's your loss ratio capacity? How do you guys think about it?
So, we sit at the early stage of the ecosystem. So I think what drives co-investment is also diversifying and sharing risk, right? So when we think about it, early on you're taking, you've got management team risk, you've got technology risk, and you've got execution risk. I think like Dhiraj was saying, the later stage you go, even for a tech company, it's not just one founder, but you have a team of founders with the leadership below them. The technology has kind of been proven, and then you're really saying it's execution risk, right? This technology has worked in Bombay, now you're going to take it to Bangalore and Delhi. And I think also when we fail, I think, we don't want to fail on, let's say, innovation or technology risk very early because that's what you're backing. But ultimately, it's the execution that really matters, and which is why you're seeing, a couple of, let's say, CEOs adding to their teams with, other CEOs joining them or other senior leaders coming to them. If you look at, just coming back to your question on loss ratios, I think, of course, it's a very broad funnel when you start with. I think the challenge about being an Indian investor in India, sitting in India, is that there is so much noise, right? There's so much clutter. In our business, you've talked to people in the valley, and they say the best VCs are the ones that say, that can most quickly say no, right? Can you say no in 1 minute versus taking 1 minute, 1 hour to say no, because that's just not a good use of time. So if you break it up, I think you look at the progression, you have perhaps let's say one half, I would say about maybe 1/4 go to A, of that about another half go to B, and then it's a trickle down effect, right? Which is why you're seeing a lot of capital chasing those winners. So what we do is we also will limit our first check. We never invest more than like $500,000. We will sometimes do interim bridges if companies doing well, and leave more dry powder and like a greater reserve ratio, right, to go in deeper into the next rounds. I just had one element, I think, because there is so much interest in early stage, or rather in tech, that there are a lot of new structures emerging. For example, we've been approached to consider top-ups, right? Let's say either on a blind pool level or like for a smaller basket of securities.
I see.
There are recently there's an announcement, right, where people will say, here's a managed pool account. We can't invest into a fund, but you can take different economics on that, right? Just think of us as extendable capital. And there's a lot of that capital now from corporates and strategics, family offices who want to partner with early stage VCs and startups, and saying that, if you show us companies, there are different ways. We may come into the fund, we may do a top up, which was not the case 5 years ago. So I think earlier it was just plain vanilla for early stage. Now there are a lot of new structures emerging.
Interesting. I think we're just running out of time, but I will request each of you to give us one piece of investment advice, because we all look at investments very differently. So, what would you share with the audience in terms of an investment advice, in terms of your approach, or things to do, things not to do? What would your piece of advice be for us? How do you think of investments? Yeah.
Well, investing fundamentally is about collecting a check, not writing a check to begin with. So ultimately, investing is when we realize returns. I mean, it's difficult to say one, but ultimately buy businesses that you believe in, that you like. fundamentally.
So you spend enough time on an investment and understand it before you start to
We
even
try to.
evaluate investments.
We try to, doesn't mean we get it right. And then the biggest issue, at least for us in India, is the human capital.
Right. So
Right?
the
That
team.
is the single big, most of what we've seen is it's very little to do with market. The market here is very opportune, it's largely underserved.
Right.
It's getting the human capital elements right. And dealing with it sooner rather than later.
Within your companies and within your team as well.
Both.
Both sides.
Yep.
Sanjay, what about you? I mean, how do you look at investments and what would you share with us today?
Sure, absolutely. So, again, because of where we sit, I think, I absolutely agree with Sandeep when he talked about the team, right? When we look at the team, the market and the product, I think the team is first and foremost because we've seen great teams, adapt or pivot, go to other ideas, but the team is really what you're backing. I think one thing I've discovered that it's a very long-term game, right? And anybody at least involved in early stage or angel investing shouldn't expect quick returns. So it's almost like when we go and pitch to HNI's family offices or large institutions, the advantage is that larger institutions know that it's a long-term game, but lots of family offices or others may not know. So that's one. And I'll just quickly say that. We will all make mistakes, and we have made mistakes, right? And I think page 6 only talks about the successes in that sense. So at some point, you have to make a decision and move on. The question is that where can you limit that risk, right? So you've got to make that decision with 50% of the data, not 100%, and go a little broader because you don't know where those winners are going to come from.
Right. Yeah. What do you think, Dhiraj?
It's not an easy question to answer in some ways, but some of it is a little bit of how we structured. So not unlike Sandeep, I think our partners also have a fair amount of their own money in the fund. It's not as high as 15%, but over the period of time, we've just committed more and more. So the way we think of our business is each partner is effectively running out there and using a certain amount of the pool of capital to build returns. And one of the things that we've figured out over time is simply there's a flywheel effect on good investments. You make a few good investments, you're on a proper confidence, you're more choosy, picky, you're seeing things right way, you end up making better investments, and that just feeds on itself. And the reverse is equally true for the same partner, right? So we try very hard to ensure you don't get bogged down by situations you didn't anticipate going in.
Right.
And I think the partnership is structured to ensure that anybody who's in the deal mode, and it's very easy to get into deal mode, is often asked to pause and think about what he's doing or she's doing, so that you don't see your colleague or your partner make mistakes and get bogged down. It just sort of hurts the fund overall over a period of time.
True. Everybody's got skin in the game.
Everybody's got skin in the game.
All right. So from our perspective, on the public markets, I won't dwell much at all because Sir John Templeton's 16 investment tenets are known by everybody. But when it comes to private equity and the angel investments that I do, I think there's one thing that I've learned, and I try to apply it as much as I can on companies that I work with, is the incentive structure. I mean, I can give you a lot of market kind of knowledge, but I think it's extremely important to get the incentive structure of people right. And that's just in addition to the team and the construction that we spoke about, the long-term nature of the business. Within our team and in our portfolio companies, we focus a lot on making sure that incentivization of everybody is correct. And because that drives, most of it is human nature, and that drives people. So I think that's about it from us. Thanks a lot for a patient hearing. We have run out of time. There are no questions that we can take now. So thank you so much.